morning, Lagos. Good morning, all our listeners across the world. This is Follow the Money with Ugodre, brought to you by Naira Metrics. Every Monday on Classic 97.3 FM between 8 a.m. and 8:30, and on all podcast media, Spotify and all others. Welcome to this morning's show. Stocks on free fall. Nestle making a smart move. How bold is international breweries move? And UBA and Fidelity announced capital raise. For this first segment, I'll hand over to my brother and my friend, Ugo. Over to you.
All right, Wade, thanks for the intro. Good morning, Lagos. Good morning, everyone. Welcome to Follow the Money once again. Wow, what a week it was last week. Stocks on a free fall again. We did record more losses. The Nigerian All-Share Index market capitalization depreciated by 2.71% to close at 99,539.75 points. So we've kind of like dipped under the 100,000 points for the first time in almost 2 months. Stocks were flying, as you all know, in the first quarter of the year. So we've now dipped below that psychological barrier, and currently market capitalization is currently 56.29 trillion as well. Nevertheless, indexes, the stock market index, as the broader stock market index, all-share index as it is called, still up 33% year to date. Looks like it's now likely to dip below inflation. Where has all those bulls gone? Where are they? The bulls are suddenly no longer there. Bears just taking over the last 2 weeks or so. Of course, the NGS 30 index also fell as well during the week. So looks like it's just been a free fall for stocks. Basically, NGS 30 index fell 2.8%. The consumer goods index also fell 8.1%. In fact, that index is down 4.5% year to date as we speak. Also, the premium index, which is the index that has the most capitalized stocks, that's the biggest stocks, including the SWOODs, fell 2.3% during the week, which is about 34.59%. Yet they're currently up 34.9% year to date anyway, but they fell 2.3%. Of course, the banking index, that is actually what has been dragging the entire stock market down. It appears like that the bank recapitalization plans announced by the central bank has seen stockbrokers or investors essentially dump bank shares. And that is understandable because it appears the impression is that since banks are going to be raising that much capital, their share prices, if you recall, last week I did mention it was two things that happened. It was either the share price will remain strong ahead of the capital raise so that banks could raise, could give out a lot less shares, or their share prices might dip so that those who want to buy a right issue, the shareholders who want to raise capital through a right issue might not need to give out so much shares. So it appears this latter that's happening. Kind of makes you wonder whether the valuations that we saw earlier in the year were actually real. But bank stocks down 11% this week alone, down 12% already year to date. So that's what's driving. And you can see the pension index as well. That was doing pretty well before. Is now just 7% year to date up. So interesting things going on there. And of course, top 10 gainers for the week. We saw Guinness gained 10% during the week. Quite unexpected. Share price closed at 55 Naira. So interesting to see what's going to happen there this week. I'll pay attention to Guinness. The Morrison, I don't like talking about penny stocks on this show, but you know what? Let me just say this. Morrison Industries up 45%. You ask me what Morrison Industries is, I don't know, but I mean, up 45%. Was the top gainer last week. But second was Guinness, 10%. Academic Press, 10% as well. You can see just all right in the mix. The only non-penny stocks that kind of have good values, maybe like Guinness, NEM Insurance up 8.3%. Last week. So pretty bad week. But if you look at the decliners, that's where you see a number of heavyweights. You see GT Co down 19%. GT Co is now down to 33.5 Naira. Unity Bank also down 19% as well during the week. We also saw Jais Bank, another bank, down 14.9%, essentially 15% during the week. So a lot of stocks lost ground during the week, and that's why you saw the market capitalization dip. Looks like the bears might take charge again this week, but we'll wait and see. We're done with the IMF spring meeting, so likely going to have CBN officials back at work, and maybe a slew of pronouncement might change the tide. But looks like that's what. Besides that, could be another bearish week we're entering. By the way, there are price adjustments. Dangote Cement adjusted its price, which means dividend has been adjusted. So if you didn't buy these shares when you want a dividend, you can't buy it anymore. So price has been adjusted. Transcorp Hotel also adjusted price. Beggar Paints as well, and CWG PLC, all price adjusted ahead of dividend. Now, there are two stocks that propose dividend in case you want to earn their dividend. Fidelity Bank, which we'll talk about in the second segment of the show, proposed dividend of 60 kobo per share. Qualification date 26th of April. That means if you want to own these shares, you got to buy it on or before the 26th of April. If you don't buy it by then, you're not going to own the dividend. You're not going to be able to earn the dividend for this share. So they pay their dividend on the 15th of May, just less than a month from now. And Industrial and Medical Gas PLC also proposed dividend of 50 kobo per share. Qualification date is 16th of June, still far away. They don't plan to pay dividend until the 2nd of July 2024. So that wraps up the first segment of the show. So bears in charge, stocks in free fall. Let's see what happened this week. We got to be positive anyway, but keep your eyes closed to what's happening in the stock market. Look at your portfolio. Be sure that you have the right mix and the right balancing, because it's looking like it's going to be a bit of a wild second quarter for 2024. Back to you, Ade.
Thank you, Ugo, for the market roundup. We'll take a short break now. When we're back, we'll be speaking to our guest, Oladipo Ajayi.
You're listening to Follow the Money with Ugodre.
Welcome back. Our guest today is Mr. Oladipo Ajayi, a financial instrument trader and portfolio manager with close to 2 decades of experience in the financial market, both domestic and international. He has vast experience in trading local and foreign currencies, bonds, commercial papers, promissory notes, and treasury bills. He set up the fixed income trading desk at Primera Africa Securities, where he headed the fixed income desk. Oladipo worked with Equatorial Trust Bank, Intercontinental Bank, Express Discount Limited, Primera Africa Securities, a seasoned professional with specialties in treasury management, modern portfolio management techniques, sales of financial instruments, business analysis, and economic analysis. He's also a seasoned financial analyst and has featured on TV programs with TV stations like CNBC, TV Continental, Arise, News Central, just to mention a few. He's an associate member of the Institute of Chartered Accountants and a CFA charter holder. Chartered holder. Good morning, Mr. Oladipo Ajayi. Welcome to Follow the Money with Ugodre.
Good morning, and thank you very much for having me on this morning. And it's a pleasure to be available this morning.
It's great to have you on the show. On this second segment, we'll be looking at bank capitalization and a number of news that are coming out from the banking sector. So, UBA PLC is seeking approval of to issue 10.8 billion new ordinary shares at its annual general meeting. According to the notice, they want to raise the capital of they want to raise their capital from 17.099 billion to 22.5 billion. About 45.9 billion ordinary shares valued at 50 kobo each. The move is to move their current combined share capital and share premium of 115.8 billion to about 384.2 billion of its required capital base of 500. So when you look at UBA's results for 2023, fantastic earnings. How do they raise 200, 400 billion, if not more, to continue as a tier 1 bank. Will they be able to achieve this?
Well, if you look at it, I think the best thing that I would actually say around this is that I feel that the Apex Bank actually very much in the new capital structure. And if you look at currently, the expectation is for banks to capitalize to the tune of 500 billion. And it's not only that a lot of banks are not allowed to actually use their retained reserve to actually implement that. We've seen that in Egypt before that. But the difference was the fact that they were allowed to use their retained earnings and their reserve to actually implement their capital structure. And currently, it's going to be a very tough one for all banks because if you look at it, because they're not one of the banks that's actually close to 50% of the expectations. And so it simply means that the market will be crowded with a lot of banks coming in to actually improve their capital structure, more like the paid-in capital. And UBA is currently one of them. And when you look at the bank coming in to actually raise circa 400 billion naira market, it's going to be a toll for that. But what would I'm expecting the central bank to have done initially? Maybe to actually stagger this over a period of maybe a longer period more than 2 years that the central bank actually specified. Maybe they should have done like a 7-year mortgage and say, okay, in 2 years you would have made 300 billion, and by the end of 7 or 50 years you should have done 500 billion. But because of the short time, it means that a lot of banks will actually rush into the market, and that's one of the reasons why you see most of them are rushing around their AGM to ensure that they can quickly get approval to actually hit the market. And in no time, you start seeing most of them hitting the SEC to get approval to actually come to the market. But as we speak, I think it's going to be a very tough one. Most of all the banks to actually come. So he has to have the advantage of first mover advantage. Who will be first to actually come to the market that can actually take advantage of currently what's happening in the market. And since I'm speaking, most of Nigerian banks, they are actually very cheap. When you look at their valuation, when you look at their price of books, you tend to see that there's a lot of value in some of these things. But the problem is that the fact that there's going to be dilution, and that's one of the reasons, just like what we mentioned earlier, and that's why we are seeing that person drop in banking index. A lot of people are in the view that in no time you still expect the price to actually go down below the correct trading levels. So why would I need to actually buy now? I would rather wait till then when the price have actually got to a level where I feel that they are already in the market to actually raise funds. And don't also forget that this fund may not be at the same time. I don't expect the bank to come in at one time to say, I want to raise 400 billion in the market at just one time. It's going to be a very difficult one. So it simply means that some of them will have to actually start that over that period of 2 years. And maybe using offer subscription rights to do as some way to actually raise the fund. But I think it's going to be very difficult considering the size they need to raise the markets.
Okay. So just quickly, where do you think they can raise this money from?
Yeah, there's a limitation for them because the central bank expressly stated that you can't use 81 to actually raise funds. So it simply means that you have to either use right issue or subscription private placement. These are some of the windows available to raise funds. And I think that some of those banks will actually go through private placements where they already have strong ownership. Most of those ownership don't want yield dilution to their holdings. Some of those banks. So you tend to see a lot of them actually going through the private placement where they can actually raise the money privately and actually improve their holding in the company rather than actually allowing dilution. So I won't be surprised if I see more private placement than right issue. But overall, I think we'll see right issue where they keep room for every shareholder to actually take advantage of the opportunity in the market. But I don't think you can raise it via the right issue. They may need to actually resort to more private placements where the strong owners of the company will actually have to raise capital to actually improve their holding in the company.
Very good points there, Jerry. Banks probably going for private placements first before right issue, and it kind of looks like that's the moves that we're seeing. And if you track a lot of the majority shareholders of these banks and how they are moving, it kind of looks like that might be the direction for a lot of them. Another story, Jerry. Fidelity Bank posted its result last week, and net income, which is their profit after tax, was like 9.45 billion for 2023. Putting the bank up 113% from the 46 billion did in 2020. So, of course, we all know most of this was also due to FX revaluation gain. They did record 44 billion in FX revaluation gain alone. So gross earnings for Fidelity Bank now 55.8 billion, up 65% year on year. Net interest income 277 billion, up 82% year on year. Earnings per share at 3 naira 10 kobo, up 93% year on year. They also declared dividend, like I mentioned earlier. Also has a robust cash balance of 364 billion. Net assets, of course, without stripping the retained earnings, is at 473 billion. And Fidelity Bank is now a 6.2 trillion asset company in terms of total asset that they manage. So quickly here, what's your cursory view of the performance that you've just seen? And does this make Fidelity Bank closer to a tier one bank than any of the others?
Of course. Okay, if you have followed Fidelity Bank, you know that very well. Fidelity Bank is more like a bank that's in the borderline between a tier one and tier two banks. It would be unfair to actually classify Fidelity Bank as a totally a tier two bank, because let's look at it from this perspective. Currently, Fidelity needs to raise about 370 billion to actually meet the capital requirement. UBA needs to raise about 390 billion to meet the required capital requirement. So it simply means that Fidelity is even on a better pedestal than UBA in terms of actually meeting the requirements of the central bank. And the way you look at the performance of the time, they have been posting back-to-back great performance. And when you look at what they actually did in this financial year, it was a great one. And gross earnings about 555 billion, and that's up by about 65%. It's not something you see easily in the market. And you see net interest income about 277 billion, and that was up by about 82% year on year. And just like this, we are talking about a bank that is total asset is about 6.2 trillion. That's a whopping 6.2 trillion. And that's I think that would be fair to actually totally classify Fidelity Bank to a tier two bank. I will continue to put them on the borderline between a tier one bank and a tier two bigger bank. And I think I would rather skew them into more of a tier one bank than a tier two bank because of their platform. And I think Fidelity Bank, just like any other bank, will actually go through the same route, just like what you mentioned. Private placement as a priority before actually now actually trying other sorts of ways in this one. We saw what happened just recently. Fidelity Bank, they actually did something in that line where they did into private placement to actually include their explanation. Just what they did was that to ensure that they paid the issue share equals the paid in share, and that's exactly what they did. And therefore, they did not actually push that to the market. What they just did was through the private placement job, and I think that's the thing that Fidelity Bank will actually talk in this coming situation. They want to actually look at for private placement first, and don't also forget that there are most of these international that will actually dive into the pond currently. A lot of them are seeing value in most of this company. They are seeing values in most of this bank, and they are ready to actually come in aggressively to take a chunk of it. Imagine, it's easier for you to invest this round rather than going to the capital market to start lifting from the capital market. You rather want to come in and come and take maybe 10 million shares or 20 million shares or even 100 million shares. Because going to the capital market to lift 100 million shares, that will cause more of the distortion in the market and also increase the value of the prices. You may not even end up getting an opportunity to actually meet your order. But coming through this route is easier for you to actually actually get to actually buy at a reasonable price and also at a very good value. And at the same time, it would be more like a win-win to the banks and also most of these foreign guys. I was seeing some of them divesting from Nigerian market at the point time, but I think they're more like that.
Mr. Ajayi, time is always not a friend with our show. But let's quickly go on to the next question. International Breweries is in the news, and the shareholders approved the conversion of their loan, $379.9 million into equity. This is according to the notice that was provided after the last EGM. So 2 quick questions. This is a company that has racked up losses for years, and each time you see the shareholders, bail them out. So why is it important for Abim BV, despite not making profits or a dime, to be in Nigeria? Why is Nigeria important to them? And then secondly, what will be the implications of this plan to convert shareholders' debt to equity, especially for minority shareholders?
So thank you very much. If you look at international view, just like what you said all the time, they have history of loss making. And this actually is share that was at the time trading over 69, currently trading sub $5 now markets. And the problem for international builders has been their current debt structure. They're currently owing close to about 400 something billion. But currently, they have net outstanding for about 379. Let's say about 380 billion outstanding to Citibank Abu Dhabi. And what the parent company has done was what they tried to do some years back. And at that particular point in time, I think the mistake that international made was the fact that they did not fully liquidate that obligations. Rather than that, what they did was to actually use the fund to actually further expand their plan, the one that should have, and just with the mindset to expand their operation, so to be the company will grow well and they will be able to pay. And they forgot to actually take into consideration that the valuation of Naira to dollar has not been constant over time. I think that's where they actually let the ball down. And currently, this has been a problem to international builders. When you look at the country, look at what happens there, their loss worsened from about 21 billion of the year 2022 to about 59 billion last year. But one exactly thing is that when you look at their gross profit margin, it's about 20%. So what it simply means that the problem of international builders is the current debt structure. And when you look at when you dissect their financial, you will find that currently the huge loss that were posted were from exchange loss coupled with the cost of the debt. When you look at their books, you see that the rates for their dollar denominated is about 5 to 7%. But the problem is that when you translate that dollar value to Naira, it becomes a problem on the books, and that's what the parent companies are currently trying to solve. What they want to do is to actually take over the debt, totally pay Citibank Abu Dhabi, and actually convert the debt to equity. And the way they are going about it is to convert it through rights issue. So it simply means that even the other investors will also have the opportunity to actually take up their rights. And when the time comes, I'm very sure that it's not something that they're just doing without considering other shareholders. So I think it's a win-win for both sides.
A win-win for both sides, shareholders, majority shareholders and minority shareholders. Interesting to see how this pans out, Ajayi. We'll move on to the next company. Time is not on our side, so we'll probably do this quickly because we'll have one other company to discuss. Nestle. Nestle was also one of those companies that faced losses due to exchange rate devaluation. They did end up with a negative shareholders' capital of I think 78 billion or so, if I'm not mistaken. Due to the losses that they had, they've claimed that those losses are basically unrealized exchange losses. If you're wondering what that means, listeners, their point is that look, it hasn't really crystallized yet. Because it's just a bit of an accounting entry. But look, you will crystallize at some point because you don't except the exchange rate goes back to where it was at some point last year, maybe about 700 Naira. But at the moment, that is what they've booked. But Ajayi, Nestle is doing something quite ingenious here to cover the losses. That's the negative shareholder funds. They plan to revalue their assets. Revaluing their asset means that they likely go from I think from what I've seen in their notes, assets will now be valued at over 300 billion or thereabout. Why are they doing this? And is this not kicking the can down the road?
Well, I think just exactly what is like what Nestle is currently doing is that treating the symptoms rather than the underlying illness. And it's just a way, it's more of a window dressing to me. Because, of course, there's nothing wrong with actually valuing assets. It's accepted on other. But when you do it in this model, it tells you that you are already trying to actually cover something. The whole world is aware they're currently having negative shareholders of over 78 billion. And going this route, I think that's not totally the right thing to do in such a time, because people are not in that sentiment that, okay, maybe they are trying to cover something or they are trying to cover their losses. But that's not the. But when you look at this as a company, it's a very strong company. I think if you look at all the FMCGs, Nestle is the best when it comes to when you look at their gross profit margin. They have gross profit margin of about 40%, and that's massive. And when you look at their revenue, they grew revenue by about 2.4%. Their EBITDA margin actually improved to about 24.8% from 17.8% that we saw last year. So the main problem is what's affecting them. That's the same thing that's affecting international video, same thing for Dash, same thing for most of these FMCGs. And the problem is FX. And because some of them they are exposed to FX, some of them they draw down on their lines, and now they need to fund that obligation. That maybe some of them when they drew down and the conversion rate was maybe 700, but now you need to face the reality of where market is the current. And I think what I've expected Nestle to do was the exact thing that happened, where they converted the loan, since the loan is from the very money, converting the loan to equities or shares. It could be a very good one. We are talking of just like when you're doing traditional sector bakery, gain about 10% last week. It's actually massive. One of the reasons, because everybody feels that now they don't have anything that will actually continue to actually deplete their revenue or deplete the income. And that's exactly what I'm expecting them to actually do. In such a time like this, not about revaluation of valuing their assets. Talk to your parent company around this, find a good ground where get off that some of these debts to equity, and by so doing, you'll be able to pay all your country, you're able to apply that.
All right. Thanks for that, Ajayi. Time is no longer on our side. So I'll just round up with important announcement that we got yesterday from the website of the Nigerian Stock Exchange, or the NGX as they are now called. First Bank, major changes in First Bank. Their elsewhere MD CEO Dr. Adeshola Adeduton resigned his appointment as managing director of the bank over the weekend. Over the weekend, and then they have appointed a new acting CEO already, and a new acting CEO already by the name of Olusegun Alebiosi. So this is one to watch. No time to go through it, but is one that we're going to be tracking at Nairametrics. So follow Nairametrics for more updates.